This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Paying you back. All U.S. banks pass the stress test and get the okay to deliver dividends to shareholders. Are there names that you should add to your long-term holdings?
Passive power. Investors are plowing money into exchange-traded funds, and that may be a big reason for the market's rally. Should you be concerned?
Pension freeze. More companies are changing their retirement plans. The question is why? Those stories and more tonight on Nightly Business Report for Wednesday, June 28th.
Good evening, everyone, and welcome. It was all about the banks today. The financials led the market rally and could potentially lead stocks higher tomorrow. Late today, in an indication of how much healthier the financial system has become, the Federal Reserve gave the biggest U.S. banks the green light to use their extra capital for stock buybacks and more dividends. That's good news for investors looking for extra income. Kayla Tausche has more now on the final results of the central bank's so-called stress test.
For the first time since the financial crisis, the Federal Reserve has not rejected any of the capital plans submitted by the 34 banks getting stress tested, finding the companies to be sufficiently capitalized to return money to shareholders while weathering a recession. The Fed did find risk management issues at Capital One. Capital One's required to resubmit its plan within 6 months or risk its shareholder payouts getting frozen. The company's levels exceeded the Fed's thresholds, but it did once already adjust its shareholder returns before the stress test results were first out last Thursday. American Express did the same as one of its capital levels was below the Fed's threshold. Senior Fed officials said the rapid growth in credit card balances, an uptick in delinquencies, and a stress test that included more severe losses for credit cards all played a role in this year's assessment. Amex cleared the bar by resubmitting its capital plan. Senior Fed officials said, unlike years past, getting close to the threshold won't be met with a supervisory penalty. And to that end, banks have requested substantially increased shareholder payouts. These officials say banks will be getting close to returning 100% of their net revenues to shareholders. At this time, that would also be a post-financial crisis first. For Nightly Business Report, I'm Kayla Tausche in Washington.
And the banks were quick to react. Here's what some said almost immediately after the results were released. Citigroup doubling its dividend and launching its biggest buyback ever. Morgan Stanley raising its dividend by 25%, American Express by 9%, and Wells Fargo by 3%.
Fred Cannon joins us now to discuss big bank names he likes now that they've been approved by the Fed to pay out more dividends to shareholders. He's Director of Research at KBW. Welcome, Fred. Good to have you with us. So,
great to be on. Thanks.
This is good news for the big banks, the ones that have been sort of restricted from paying back buyouts or dividends to shareholders. If I don't own these banks already, is it too late for me to benefit from this?
We don't think so, especially the biggest banks, because what you're seeing here is both the results show that they're very strong on capital. Credit is good. They're going to be paying a lot back in repurchases and dividends to shareholders. And we have a situation where, things are looking pretty good from a regulatory standpoint, too. Valuations are reasonable. So we continue to think the biggest banks are the best opportunities for investors today.
Who do you think is the best positioned in terms of its stock price and also in terms of its future growth plan?
Well, growth really isn't necessarily what you're looking for in the big banks today. But we think in terms of their plans and where they are today, we think Bank of America is top of our list. Very good results today. They're making good progress in terms of managing the cost, and all those legacy issues of lawsuits have started to wane. So that's our top pick. But if you look at J.P. Morgan, another one in very good shape, above expectations today. And Citi, of course, buying back shares below tangible book value is always a good thing for a bank.
So let's talk about going a different direction. Is there an argument to be made if I don't want to buy and hitch my wagons to an individual bank that I shouldn't just buy an ETF, a bank ETF?
Sure. KBWB is the one to be in.
How did I know? Did I set you up for that, Fred, or what?
You did. That's the one that is weighted towards the largest banks, and that's where the best value is. So we do think if you want an ETF, we have one for you.
What did you think of the results of the stress test? Have you had a chance to really review the Fed's comments? And what was your reaction to the way that these banks have now managed to improve their capital levels and their balance sheets?
Well, I think it was both a positive and a relief. we continue to worry each year that the Fed is going to go after at least one or two banks and fail them. Wells Fargo was on top of people's list of concerns this year because of all the problems they've had over the last year and a half. Yet Wells Fargo got over the hurdle too. So yes, we had a resubmission by Capital One, but overall, I think it really confirms a couple things. One is the stress testing has become a way of life for these big banks. They know how to do it. The Fed knows how to put out proposals, and we know how to get it so that the banks can have very positive returns. So I think not only is it a positive, it's also a relief, and it shows you that the process is well in place. And if we get somewhat lighter regulatory touch from the new administration, these numbers could improve even more as we go into 2018 and 19.
Fred, great to see you again. Fred Cannon, KBW.
Great to be on. Thanks.
Shares of Goldman Sachs and JP Morgan helped lead the Dow to a triple-digit gain today, helping the major indexes rebound from their worst session in weeks. The Dow Jones Industrial Average rose 143 points to 21,454. The Nasdaq added 87, and the S&P 500 was up 21.
Well, we just talked about ETFs, and the boom in passive investing is fueling the stock market rally. According to the Wall Street Journal, exchange-traded funds, or ETFs, spent $98 billion buying U.S. stocks during the first quarter, even as stock market valuations appeared high and other big buyers were stepping back. So, will ETF buyers continue to help drive this market higher? Michael Venuto is chairman of the Torosso ETF Industry Index, which tracks the performance of the ETF industry. Michael, welcome. Good to have you with us.
Thank you, Tyler.
So, do I need to be worried about this phenomenon? How big is it? 98 billion sounds like a lot of money, and by any measure, it truly is. But is it creating sort of bubblicious territory in the market?
I like that term, bubblicious, but this is really about the law of large numbers, right? The ETF industry has been growing at about 20% a year in assets for about 10 years. And at $3 trillion today, 98 billion is only about 3%. So it is a huge number, but in a percentage terms, it's within historical norms. It's part of the growth of the industry.
You know, not all ETFs, though, are created equal. There are some kind of hybrid ETFs that are out there. So as the investor looks at that landscape, and if indeed you're correct, and we may see more expansion into this part of the market, what do you watch for?
Well, you got to watch and know what's in an ETF, right? Like, it's not just about what the name is. You have to know what is actually happening under the hood and how the process of creating the index works.
So when the money is put into an ETF, let's say a financial advisor says, I'm going to take your capital, I'm going to put it into an ETF because you get very good price efficiency, low expenses, you get diversification. All of that money has to get put to work across the index or whatever the benchmark is that the ETF is measured against or created out of. That really doesn't cause anybody to be discriminating into whether they're buying good values or not, does it? I mean, in other words, all of that money's getting put to work regardless of whether this stock is overpriced and that one is underpriced.
You're absolutely right. And in the broad-based indexes like the S&P or the QQQs, I don't think that's a problem yet. ETFs, on average, own about 6% or so of those kinds of names. But when you get into more niche-y things like REITs, for example.
Interesting.
REITs, for example, today, it's about 15% of the market cap of most REITs are owned by ETFs. And I think that's because investors are looking for yield, and ETFs are a better way to get them. So they go passive, and you have to watch that. That's a place where, to steal your term, Tyler, it could be bubblicious.
All right, Michael, we have to leave it there. We'll be back and talk more about this interesting story. Michael Venuto with the Torosso ETF Industry Index.
To real estate now, where fewer buyers sign contracts to buy existing homes in May. That is likely because they can't find a home that they want, and if they do, it's probably too expensive. The lack of inventory on the market could be behind the 0.8% drop in pending home sales last month, marking the third consecutive decline. As we've been reporting, there isn't enough housing supply to satisfy demand, and that is causing prices to rise, increasing the number of homes that are out of reach for buyers.
We've also seen an increase in demand for rentals, especially rental apartments, and while prices for those are rising as well, one developer may have a solution, and he hopes it catches on with the younger, more social generation. Diana Olick has a story from Chicago tonight.
From the outside, this Chicago apartment building looks like any other. But inside, there is an experiment going on.
I was a little bit hesitant, and then I started to think about it more. And I thought, living alone isn't that great.
Dan Elch is co-living in an apartment that was specifically designed and built for 3 independent residents. It's not just a roommate thing. Each room has its own bathroom, and the common area is fully furnished with all the amenities from flatware to flat screen. And each resident has his or her own lease. The monthly rent is cheaper because of the share. It's the brainchild of Ryan Shear of Property Markets Group, an apartment developer operating in New York, Miami, and Chicago.
How do you make your home a place that you connect with somebody, right? So you have to attract the right demographic. Everybody's welcome, but young professionals is a target demographic. And how do you connect them?
Through communal spaces in the apartment and in the building, like this open roof deck boasting a real Chicago L car for parties and such. Noah Gottlieb, another PMG partner in the project, also lives in the building, monitoring the experiment.
So you don't want a dirty roommate, right? So we're going to clean your apartment every once in a while. You don't want a roommate that you don't like, so we're going to allow you to move within the building if you don't like your roommate.
A year in, he claims there have been very few problems, and demand was off the charts.
We did 30 deals in 35 days.
Less than 10% of the units in this building are social, and that's by design, literally. The concept is so new that investors aren't quite ready to buy into a fully social building.
It's been like evolving over many years. It's not something we said, hey, let's just jam people together and like have a party. It has 10,000 moving parts to it. Our ability as a developer to control all of them, I think, is massively like a huge competitive advantage to somebody else.
Others like We Live and Common also offer co-living, but it's a different model. They don't own or build buildings, but act more like hotels, offering short-term leases. The leases here are 1 year. PMG is already developing other properties which will have even more social units.
Everything will have absolutely an element of co-living because we want to hit that price point. We want to cater to the people that, co-living really does, for the most part, solve a price point problem, right? It's your cheapest entry into a building.
Dan Elch just signed his 2nd-year lease.
I think it'll continue, especially as people move around a lot and they're not so much fixed at an early age, to a location. And this is a great bridge to like a new city or a new area.
And a new way of living. For Nightly Business Report, I'm Diana Olick in Chicago.
UPS is the latest company to freeze its pension plan for non-union employees. That change could affect more than 70,000 people. The company's not the first to do it and likely not the last. Morgan Brennan takes a look at why more companies are moving in this direction.
Starting in 2023, UPS will offer 401k plans instead of the traditional pensions it currently offers non-union employees and contribute to those accounts beyond any employee savings match. The move only affects about 17% of UPS's workforce, but it speaks to a much bigger trend in corporate America right now: ballooning pension liabilities. UPS had a nearly $10 billion pension deficit last year, and according to Mercer, the shortfall of all S&P 1,500 companies combined was nearly $400 billion as of April. Why? Stubbornly low interest rates, tighter regulations, and the fact that many people are living longer. More employers are responding by freezing traditional retirement offerings and switching to 401ks. Willis Towers Watson says from 1998 to 2015, the percentage of new hires at Fortune 500 companies offered traditional pensions fell from roughly 60% down to 20%. And about 40% of employers had a frozen pension plan altogether. Among those that have done so, Boeing, U.S. Steel, Kimberly-Clark, and AIG. What's more interesting, many, like General Motors, United Technologies, Sears, and just last week Accenture, have also offloaded those obligations, shifting them to insurers like Prudential Financial and MetLife. The strategy makes the employer's balance sheets less volatile, and it creates a source of growth for life insurers, which have also struggled amid low rates. For Nightly Business Report, I'm Morgan Brennan.
Still ahead, the popular weed killer at the center of a growing controversy.
The Food and Drug Administration is taking steps to increase the number of generic prescription drugs on the market. The agency says the move would make medicines more affordable and give people increased access to the drugs that they need. The commissioner added that while the FDA does not have the power to regulate prices, it can help increase market competition.
We're looking at the places where there aren't a lot of generic competitors. We're now publishing a list. We announced yesterday we're going to publish a list of all the places where there's only one generic drug on the market, or where there's basically patent exclusivity has expired on a branded drug, but there's no generic competitors. And we're also going to be prioritizing the entry of new generic drugs into a category until there are 3 competitors, because we really don't see the big price breaks for consumers until there are 3 competitors in the marketplace.
The FDA has also scheduled a meeting in mid-July to discuss possible changes to its rules for approving generics. Those rules have inadvertently enabled some brand-name drug makers to prevent or delay generic rivals.
Strong demand for soybeans helped Monsanto's bottom line. The seeds company reported quarterly profits that were better than expected. Soybean seeds represent the company's second biggest business by revenue. Monsanto also being bought for $66 billion by Germany's Bayer. If the deal is approved, it will create a company that commands more than a quarter of the world market for seeds and pesticides.
And the main ingredient in Monsanto's popular pesticide Roundup is at the center of a controversial move by the state of California. A government office there said the ingredient causes cancer and plans to classify it as a carcinogen. But Monsanto vows to fight back. Aditi Roy has more.
Whether you battle weeds at your home or in your fields, Roundup branded herbicides are some of the most effective methods for controlling them.
Roundup is the most widely used weed killer in the U.S. and the world. It's also agrochemical giant Monsanto's flagship brand, used on genetically modified crops like corn and soybeans. But the active herbicide in the product, glyphosate, is at the heart of a legal battle in California. The state has added glyphosate to a list of chemicals known to cause cancer. Some scientists agree with the decision.
It allows another agency to come to a scientific conclusion on the health effects of this chemical.
But Monsanto vehemently denies the claim, pointing out that the Environmental Protection Agency and other regulators worldwide have approved the herbicide. In a statement, a Monsanto spokesman says, "We will continue to aggressively challenge this improper decision." The trouble started 2 years ago when the World Health Organization's International Agency for Research on Cancer identified the herbicide as probably carcinogenic to humans. California's Proposition 65 requires certain chemicals identified by that agency as carcinogens to be added to the state's list. Monsanto went to court to stop the move, but a judge dismissed the suit. The company has appealed the decision. In the meantime, another battle is brewing in Arkansas. In this case, the state's plant board has banned the use of dicamba, the active herbicide in another weed killer made by the company. The state's governor still has to sign off on the ban for it to take effect. In this morning's quarterly earnings call, company CEO Hugh Grant addressed an analyst's question about dicamba.
The number of inquiries we're experiencing would be normal for any product. Even products that have been established in the marketplace would experience a number of inquiries every year. So we feel really good about where we're at.
Glyphosate is currently under its standard re-registration review in Europe and the U.S. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Fewer promotions helped results at General Mills, and that is where we begin tonight's market focus. The maker of Cheerios and Haagen-Dazs ice cream also said cost cuts contributed to the company's better-than-expected profit. Sales edged lower, but they were still strong enough to beat analysts' forecasts. The company also raised its quarterly dividend to 49 cents a share. General Mills up more than 1.5% to 56.42. FedEx said the cyber attack that hit companies and governments around the world yesterday could have a material impact on its financial results. The company said worldwide operations of its delivery unit TNT Express were significantly affected, but FedEx did note that it does not believe any sensitive data were stolen. Shares rose more than 1% to $217.15. And the Dutch healthcare company Philips will buy U.S. heart device maker Spectranetics for more than $2 billion. Philips said the deal will allow it to further expand its image-guided therapy business. Spectranetics up 26% to $38.35.
The payroll services company Paychex reported sales grew and topped estimates. Earnings also rose, beating expectations. But the company's guidance for its next fiscal year came in shy of analysts' forecasts, and that sent shares lower by nearly 2% to $57.65. And the home goods retailer Pier 1 reported a narrower than expected loss in its latest quarter, but the good news pretty much ended there. The company said same-store sales were flat, while overall revenue fell and missed estimates. Shares of the small-cap stock initially plunged in after-hours trading, but it ended the regular session up just a fraction to $5.38.
Blue Apron, the biggest meal delivery company in the United States, is going public. While the meal kit delivery business is growing, it is also changing very quickly, with Amazon's recent purchase of Whole Foods as a major looming threat. As Bob Pisani reports, that is a big concern for some investors, and it prompted Blue Apron to cut its IPO price range.
Blue Apron is in the business of delivering meals, but Amazon's purchase of Whole Foods has changed the dynamics of home delivery. It could easily get into Blue Apron's business. Here's the good news. There's decent growth. Their revenues are likely to hit $1 billion this year, and gross margins are healthy. They've got a lot of repeat orders that accounts for about 90% of their revenues, and it's reasonably priced compared to competitors like Grubhub. Here's the bad news. They're losing money because they're spending a lot on marketing. They lost $50 million in the first quarter because customer acquisition costs, that's the cost of getting new customers, are rising. And competition's ramping up. So you have HelloFresh, which is ready to go public in Germany. It's already in the U.S. There's others, Home Chef, Plated, but the big white shark is Amazon. Amazon Fresh right now is just doing grocery delivery. And while that has not been a strong suit for Amazon, you can be sure that home delivery is a big reason for the Whole Foods purchase. It spells major competition for Blue Apron. By the way, this may be bad news for Blue Apron, but it's good news for everyone who wants to buy Blue Apron. After all, if you're an investor, would you rather buy it at 11 or at 16? For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Coming up, we go behind the wheel of a self-driving car.
It is the next advancement in self-driving cars, going hands-free in Cadillac's CT6 with Super Cruise. That story coming up on Nightly Business Report.
The Department of Homeland Security is calling for new security measures for airlines flying to the U.S., but is stepping back from expanding its ban on traveling with laptops. In March, DHS prohibited personal electronic devices in the cabins of planes departing to the U.S. from 10 airports in the Middle East and Africa. Officials say there will be enhanced screening of passengers and their belongings at foreign airports. The new rules will affect 180 airlines operating in 280 airports in more than 100 countries. The existing electronics prohibitions could be lifted at those 10 airports if officials there comply with the new procedures.
The CEO of General Motors says the world needs more computer coders, and that's why Mary Barra announced a new push to train engineers. Barra said that cars today have hundreds of millions of lines of code, and that's why the automaker is partnering with 4 organizations to help train teachers who will teach more than 40,000 students during the upcoming school year.
The newest feature in self-driving cars has the car watching the driver to make sure they're ready to take control on the highway in case of an emergency. It's all part of Cadillac's new Super Cruise technology. How does it work? Well, Phil LeBeau takes us for a ride just outside Palo Alto, California.
Cadillac calls its Super Cruise technology a game changer, allowing hands-free driving on the highway while ensuring drivers pay attention. Radar and sensors watch what's happening around the CT6 sedan as a small camera on the steering column watches the driver's eyes and head position. If you focus on a text message or doze off behind the wheel, the Cadillac will alert you to take control.
That seemed like a really long time.
The technology is designed to lift the driving experience, according to the head of Cadillac, who took us for a hands-free drive.
We've designed the system to engage the driver. And the sensors that are embedded in the vehicle certainly make sure that the driver remains alert You don't have to drive. You can have conversation and dialogue as we are doing now.
Super Cruise comes more than a year after Tesla made a big splash and grabbed headlines with its autopilot semi-autonomous technology, which allows drivers to take their hands off the steering wheel for short periods of time.
This is definitely a shot across the bow of Tesla, which already has autopilot. So Cadillac is really trying to take Tesla on in that category of technology.
Cadillac believes Super Cruise raises the bar compared to Tesla's autopilot.
Ours is the first system that allows completely hands-free driving. The other proprietary systems out there require the driver to periodically put their hands on the steering wheel. And that is one important difference.
Cadillac CT6 with Super Cruise goes on sale this fall, and while the company has not said what the price will be for this feature on its CT6 models, they do believe that it will be in demand by Cadillac buyers. Phil LeBeau, Nightly Business Report, Palo Alto, California.
That's Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Thanks for me as well. Have a great evening, everybody, and we'll see you tomorrow.